Good morning, everyone. A very warm welcome to the Income Tax Symposium, New Income Tax Bill, Amendments, and Courtroom Update February 2025. I would now like to introduce our speaker, Mr. Vivek Jalan and Mr. Giridhar Delia. Mr. Vivek Jalan is a qualified CA, MBA, qualified LLM, and LLB. He is the partner of Tax Connect Advisory Services LLP. He is also the regular speaker at various professional forums specializing in both direct and indirect taxes. Mr. Giridhar Delia is a qualified CA, CS, qualified LLB. Mr. Giridhar Delia is an advocate of High Court Calcutta and executive committee member, AIFTP East Zone and associate counsel of Tax Connect. During the session, please put your video phone and microphone off. If anyone has any query, please feel free to write in the chat box. We will address all queries at the end of the session. Now we request our speaker, Mr. Vivek sir, to take the session forward. Over to you, Vivek sir.
Thank you, Namrata. Am I audible?
Yes, sir.
Thank you. So, very good morning to all the participants and welcome to this webinar. Good morning, Girdhar ji, and thank you for joining. I'll just share my PPT. Is my PPT visible?
Yes, sir.
Thank you. So, friends, watershed moment. When the new finance bill the new finance bill was presented on 1st of February and the new income tax bill was tabled by the Honorable Finance Minister in the Parliament on 13th of February. Over the last 2 days, we have been analyzing the new the new income tax bill 2025, and we have the salient features. We have read a lot of it in the media, some of it in the day before the bill was tabled officially in the parliament was not, so to say, accurate. What was reported in the media, for example, the tax residency rules have been changed. That was reported widely. That does not seem to be the case. So here in this webinar, we would analyze by and large the various important salient features and most important amendments. We have all heard about the simplification and what the FAQs published by the CBDT have spoken about the conciseness, lucid way in which the new finance bill is presented. Here we would deep dive into the intricacies and the changes which have happened and apparently how it would impact the taxpayers. Of course, over the whole year, you see, till the time the new finance bill 2025, the new income tax bill, in fact, 2025 gets enacted, and 1st of April 2026 is the expected date of implementation of the finance bill, the income tax bill 2025. So till such time, over the next whole year, we are going to do a lot of webinar series, etc., regularly on the concerns, the issues, what issues have been, of course, taken care of also in the new income tax bill 2025. So do keep joining us. Also, you can go to our website, Tax Connect, for regular updates on this income tax bill 2025. So various important changes, amendments, issues, concerns in the new Income Tax Bill 2025. And first of all, while Girdharji would cover the assessment and appellate procedures, powers of the officers, etc., one important thing which has just come into the media by the PTI as well as Business Standard is the extension of the survey powers and also the search and seizure powers of the officers. So generally, whenever there is a search survey, the officers ask for access to the computer systems, etc., and practically it is given. But till now it was not coded in the Income Tax Act in section 132 or 133 capital A for survey. Now this has been coded in clause 253 of the new income tax bill, and we are going to refer the income tax bill section, so to say, as clauses, because until the bill gets enacted they will remain clauses. Mind that these clauses are also temporary. They might change when the final act is enacted, because a lot more changes might happen during the passage of this bill. So clause 253 as it stands now, clause 253 1, clause 1 is that the income tax authority may enter any place for survey and may require the persons present to provide necessary technical and other assistance, including access code. So very important, this including access code, which means during surveys, and in similar provisions are there in section 247 related to search and seizure. Clause 247, I would say, related to search and seizure. So nowadays, all the accounting documents, etc., kept in the computer system. So of course, the computer system access, the computer system data or information can be required currently in the Income Tax Act by the officers. But now, as per the new Income Tax Bill 25, clause 253, even they can for user ID and passwords and the access to the virtual digital space. This must have been done due to the new age accounting norms, where a lot of data information is stored on the cloud servers. Also, due to the assumed evasion due to the crypto space, the authorities feel that a lot of evasion is happening in the crypto space, and everything in the crypto space is in the virtual space. So that is why possibly this amendment has been done in clause 253 related to surveys, and 247 also related to uh, searches. Again, a very, I would say, subtle and backdoor amendment has been made in clause 104, which is corresponding to section 69 capital A and 69 capital B on unexplained money, jewelry, bullion, valuable article, right? So as of now, as per section 69 capital A read with section 69 capital B of Income Tax Act 1961, where there is any money, bullion, jewelry, or any valuable article which has been found not to be recorded or which is under recorded, then that can be, liable for taxation, right? This new clause 104, which corresponds to section 69A, that has added the word asset in addition to money, bullion, jewelry. Also, it has added the word the virtual digital asset, right, or any other valuable article. So two important clauses, two important words which are added. One, this clause 104 for unrecorded money, bullion, jewelry, valuable article, etc., would now include unrecorded or under-recorded assets as well as virtual digital asset, that is crypto, right? So this, I understand, widens the ambit of the current section 69A and 69B. Mind that the Honorable Apex Court in the case of D.N. Singh, it had held that what, and it has dwelt upon a very important concept of what is a valuable article. You see, the seniors are there over here, very senior people are there. So they would remember in West Bengal, there was a case wherein, a particular person, he was transporting bitumen from oil companies which were lifted, and the income tax department, it had held that out of 100 tons which was lifted, only 70 tons was recorded. And the Honorable Apex Court in this case of Mrs. D.N. Singh, it had held and deliberated widely on what is meant by the term valuable asset. It had held that what is a valuable article? It is something where a small quantity would result in a high value, right? But now the word asset seems to be negating this judgment of the Honorable Supreme Court in the case of D.N. Singh. An asset not need to fulfill the criterias of valuable article, which was held in the by the Apex Court, and that section as of now in the Income Tax Act. One very important change. Audio is not clear. Is the audio clear? Avik, Namrata?
It's fine now. In the meantime, it was not good, but it's fine now. You can proceed.
Okay, it's fine now. No? Yeah. So I think the voice was low. So a very important change which has come and which has also been reported across in the media. You would see as we go along the new income tax bill 2025, we are finding changes, policy changes which are there in the fine prints. So the new clause 263, which is similar to section 139 of the current Income Tax Act 1961. So that requires clause 263 1A, clause 9, that provides that the following persons shall furnish a return of income for the tax year under this act on or before the due date. Clause 9 says a person who intends to make a claim for refund under chapter 20, right? So the word due date is very important over here. From clause 263 1A, it seems that for any refund of even excess TDS which is deducted, that for that the refund has to be filed within due date. If the refund is not filed within due date, then this claim of refund, that would not be allowed. Now this needs to be deep dived and also be represented before the CBDT. Also, if you see chapter 20 clause 431, it says that the refund is due to a person who pays any tax which is actually exceeding any tax which he is required to pay. So clause 431 seems to be in conflict with clause 263. But also, how can the ministry and the authorities hold back a due refund claim just due to the fact that a return has not been filed within due date? So this, of course, affects the rights and liabilities of the taxpayer. The FAQs have said again and again that all rights and liabilities as per the current act, they are kept the same, and there would be not much policy changes. But this seems to be a very wide policy change which has been brought in by the act, possibly intentionally, and therefore this may require to be implemented, and this will have wide ramifications. One important concept which was always assumed would come, and it has come, that is the in clause 3, for the assessment years and previous years confusion, now that is over. Now there is a concept of tax years, which generally, as a thumb rule would mean a financial year. Many of the places financial year has also been used, like clause 21, subclause 5, financial year has been used where it requires to be used suitably. But tax year is now the new concept which has come in place of assessment years. The assessments will be done for a tax year. So once this new income tax bill 2025 gets enacted to income tax act 2026, 1st of April 2026 to 31st of March 2027, that would be the new tax year, the first tax year under the new Income Tax Act 2026, as and when it is notified, right? However, please note that the same time period, that is 1st April 2026 to 31st of March 2027, this same tax period would be a tax year 26-27. It would be also assessment year 26-27 with respect to previous year 25-26, right? Now, the assessments of the previous year 25-26 will be done as per the provisions of the Income Tax Act 1961 for assessment year 26-27, right? And the assessment for the tax year 26-27 would be done under the new income tax bill 25, which if enacted would become income tax act 26 going forward, right? We will come to transitional provisions in every tax law when it is when it undergoes a change in this fashion, when the entire act has been changed. That would certainly require a lot of transition to be done, a lot of transitional provisions. We'll come to transitional provisions separately, right, in this webinar itself. So depreciation, now this is a change, which would impact a little bit, but certainly might impact the way cases are argued. Girdhar ji can further dwell upon this. Generally, in many of the cases, for the purpose of section 14 capital A, it was argued that depreciation is a mere allowance and it would not be disallowed for the purpose of section 14A, as section 14A of the current Income Tax Act 1961, that required that the expenditures only would be disallowed, and depreciation was an allowance, not a deduction, and hence it was not an expenditure. Now, so it seems in clause 33. So clause 33 of the new income tax bill, that is corresponding to section 32 of the Income Tax Act 1961, right, for depreciation. So clause 33, it talks about deduction for depreciation, and 33(1), it starts with a deduction in respect of depreciation should be allowed, right? So it negates this argument that, it was argued in one of the cases in ITAT Mumbai, in the case of Hoshang the Nanavati, that depreciation was an allowance and it would not invite the rigors of section 14 capital A of the Income Tax Act 1961. So this, it seems, is negated by clause 33. Section 43B, deduction on payment basis in the current Income Tax Act 1961, that is corresponded by clause 37, right? So 43B becomes clause 37 of the Income Tax Bill 2025. Clause 37 2A, it talks about deduction for tax, duty, cess, surcharge or fee by whatever name called, which would be allowed as a deduction only on payment basis, right? Previously, the similar clause was there in 43B, but it did not include surcharge. So now even surcharges would be deducted only on payment basis in addition to tax, duty, cess, fee, which would continue to be deducted on payment basis. If you don't pay within the tax year, then you can pay, except for the current provision for payment to MSMEs, you can pay before the filing of the return for the tax year, and deduction would be allowed in that year. But now a new uh, provision for even allowability of surcharge on a payment basis. So, as has been held in the FAQs, all the amendments made in the finance bill, that is the budget of 2025, that have been incorporated in the new income tax bill 2025. However, so from what it seems, it is an inadvertent error that the provisions of the finance bill 25 relating to the extension of the date of tax neutral shifting of funds to IFSC, which was extended, the date was extended from 31st of March 2025 to 31st of March 2020 2030. So that extension has not been incorporated in the income tax bill 2025. It is inadvertent error, and during the passage of the bill this would find its place. But otherwise, all the amendments which are proposed in the finance bill 2025, they have been duly incorporated in the new income tax bill 2025. Old regime versus new regime, right? This is something which all the individual taxpayers as well as the corporates would be looking at. And while there are no major changes, but as far as the corporate tax is concerned, there are few changes which would have far-reaching implication and which would require representation before the ministry. So first of all, no change as far as the personal tax shifting to the new regime is concerned. So those who have shifted to the new regime under section 115 BAC as per the Income Tax Act 1961, they would be continuing in the new regime. So that is there in the transitional provisions. Those who have opted for the new regime, their rights and privileges would not go. They would continue to operate under the new regime. For the salaried taxpayers, they would continue to exercise the option as at present for opting into the new regime or opting out of the old regime, or vice versa every year. Those who have opted for section 115 BAP, that is the manufacturing companies who have opted for 115 BAB for paying the tax at special rates under that section in the current Income Tax Act 1961, they will continue to operate under the same regime, right? However, as currently in the Income Tax Act 1961, the sunset date has not been extended. So sunset date of 115 BAB, we all know, was 31st of March 2024. So that has not been extended, but those who have already opted before this date for 115 BAB, their rights and privileges would continue in the current Income Tax Bill 2025. One important change, and again this has to be duly represented, is the current section 80 capital M for deduction for intercorporate dividends, which is transitioned into clause 148 in the Income Tax Bill 2025. That has been done away with for companies opting for 115 BAP, the clause 200 in the current Income Tax Bill 2025. So deduction of 80M, which is available under 115 BAA for the domestic companies, that has been done away with, and of course this requires some representation to be done. Salaried employees and individuals, you see, whoever have filed the forms for opting for the new regime, who are into who are taxed under PGBP for their income, they will continue in the new regime. Their rights and privileges would continue. Those salary taxpayers, as I have already said, they can always opt in and opt out as currently in the Income Tax Act 1961. Tax slabs, no change for any individual HUFs, AOP, BOI, corporates, no change in the tax slabs in the Income Tax Bill 2025. So all the amendments in the Finance Bill 2025, they have been transitioned in the Income Tax Bill 2025. Salaries, there were many deductions, and the salaries, they were spread out in various sections. So now if you read section 15 to section 19, uh, the clause 15 to 19 of the new income tax bill, by and large all the provisions of for salaries, they are imbibed there. And section 19, it has got a very, very big table. There you can get everything related to salaries by and large, right? But as I said, individuals, specifically individuals, HUFs, and the smaller taxpayers, they have to now be very, very disciplined. And if the clause is not changed, then they must file the returns within the due date. If they do not file the return within the due date, then as it stands today, if not amended, then possibly the refunds that may not be allowed. Residency status, as I said, no change in the residency rules. They continue to be by and large the same as opposed to what was initially reported in the media. For foreign taxation, the clauses 161 to clauses 177, that covers the foreign taxation bit, right? So here there are some very important changes as far as determination of ALP, arm's length price is concerned, where there are more than one comparable. So safe harbor rules for more than one comparables, that has been apparently excluded in the income tax bill. Also the calculation by arithmetical mean for more than one comparable, that has been excluded. So this is an important amendment in as far as the determination of ALP for MNC companies are concerned. But we need to wait for the rules. Maybe the rules would prescribe for multiple comparables. Right. Also, you see a very subtle change over here, which we feel that may have a impact on the international transaction and how other countries view the new tax law of India when it is implemented, would be the provision which is there in the new income tax bill, which seems to be in contradiction with Article 3, sub-Article 2 of the double taxation avoidance agreements. Now, Article 3.2 of double taxation avoidance agreements, it says that a particular term has not been defined. You see, uh, under the DTA, it would be seen in the corresponding tax law, right? The income tax law of the contracting state. But here, what we understand from in the new income tax bill, it says that where a term has not been defined, then it could be referred to by any central tax law. So it could mean CGST law also. So this, once it is implemented, if it is implemented in this form, the implementation of this clause would need to be seen. Penalty prosecution, GAR provisions by and large structurally the same. No, not much change. Under LTCG in section 48, currently, if you remember the last Finance Act number 2 of 2024, it made an amendment in section 48 whereby certain capital assets, the indexation would continue if the long-term capital gain arises from a transfer which takes place before 23rd of July 2025. So if the transfer took place before 23rd of July 2025, then the indexation would be allowed. So that has been removed in the clause 72 as of now, but again, rules need to be seen whether in the rules it would be incorporated or not. If it is not incorporated, then for the long-term capital gain arising on enhanced compensation for those transfers which happened before 23rd of July 2024, that would require to be revisited. So, very quickly, we'll come to the transitional provisions. And as I said, the transitional provisions in any change in tax laws, which such a huge impact as the Income Tax Act, transitional provisions which would be very, very important. And over the next year, I would say all the taxpayers, the professionals, the even the individuals, they should continue to keep looking at the transitional provisions and how they are going to deal with it. January to March 2026, that would be a very, very important phase, and planning should start from now for implementation of this new income tax bill 2025. So the transitional provisions, without diving deep, because we have even our next speaker, Girdharji, who would be diving into the assessment and appellate provisions, including some uh, very important, you see, developments in the courts. So I would be touching on the transitional provisions on a macro scale. The income tax returns, right? So various questions which would come now. So income tax return for financial year 25-26, corresponding to assessment year 26-27, that would be filed under the Income Tax Act 1961. Similarly, TDS returns for Q4 of financial year 25-26, that would be filed under the current Income Tax Act. So possibly all of these return forms and all of these application forms, etc., that would go under a change. Therefore, we would have two sets of forms for the next 3 to 4 years. One set of forms would be under the Income Tax Act 1961, and another set of forms would be under the Income Tax Act 2026, as and when it is implemented. So even TDS returns of Q4 25-26, that would be filed under the Income Tax Act 2026, and as and when it is implemented. The notices for the returns which are filed before 30, for the periods before 31st of March 2026, they would be issued under the Income Tax Act. Same notices TDS returns. For the period before 31st March 2026, they would be issued under the current Income Tax Act 1961. So similarly, the replies to those notices have to be made under the current Income Tax Act 1961, right? Any orders which are passed under the old act, right? So for financial year 25-26, corresponding to assessment year 26-27, the orders would also be passed under the then repealed Act 1961. Therefore, the appeals would also be required to be filed under the current Act only, right? And all the assessment procedures under Chapter 14, they would continue to be live, right? For the next many years, till all of these legacy cases under the current Income Tax Act 1961, they are, done with. Refunds, right, very important. I will come one by one on these transitional provisions. So refunds under the current Income Tax Act 1961 would be received under Income Tax Act 1961. Appeals I have said, so demands also would be required to be paid, if any, under the current Income Tax Act 1961. So what is the challan which you would use? It would be the old challan. You see, under the Income Tax Act 1961, 1, right? So a lot of transitional provisions you have to keep in mind, and for that, as I said, over the next 1 year, you need to plan, right? Payment of taxes, as I said, is to be done under Income Tax Act 1961 till financial year 25-26 period, right? However, any penalty proceeding, right? And if you see the current Income Tax Act 1961, if you see the repeal and saving section, there is a change with the current transitional provisions. What is the change? Any penalty proceeding. So what was said in the 1961 Act when 1922 Act was repealed, but any penalty proceedings even for the period prior to 1/4/1962, that would be initiated under 1961 Act. But there is a change in the Income Tax Bill 2025. It says that the penalty proceedings also under the income tax in under for the periods 31st March 2026 on under the current Income Tax Act 1961 and not under the new act. So for penalty proceeding also current act would apply, right? As I so now again there are some critical questions which we need to answer over the next 1 year. If any advance pricing agreement has been done till date, then whether it would be valid or whether it will not be valid when this new act is implemented. What we understand is under clause 6 of the General Clauses Act, it would continue to be valid. Similarly, in the current budget, a block assessment for transfer pricing cases, they have been brought. So a transfer pricing officer can do a block assessment if there are similar issues for transfer pricing cases for a period of 3 years. So whether this block assessment would continue or not in the new Income Tax Act 26 when it is implemented, it seems that yes, they would also continue, right? Similarly is case of other block assessments, right? Now, very important, again, refunds. So say your refund was granted in March 26, you get the refund in September 26. The interest would be calculated under the current act separately, so it seems, and separately under the new act. Similarly, if you are required to pay certain taxes in, say, financial year 25-26, which you pay in 26-27, then the interest would be calculated separately under the old act and separately under the new act, although the rate of interest would continue be the same. But very important for all the taxpayers. So again, as I said, Jan to March becomes a very critical period. Use the right challans whenever you are using, right? Plan accordingly in Jan to March 2026 so that you in the transitional phase you do not do any mistakes which invites more litigation. What about in a case where deduction has been allowed under the current act, say under section 54F? A deduction has been allowed, but you do not purchase the property or construct the property as per provisions of 54F. And the violation comes to the fore when the new act is implemented, right? Again, for such a violation, when the new act is implemented, such taxability would arise under the old act, right? So again, the payment would require to be done under the old act in case of such violation. Recovery is also would be done under the current act, right? So again, all the circular, now this is very, very critical. All the current circulars, notifications, orders, etc., which are issued under the current Income Tax Act 1961, they would continue to prevail if they are not inconsistent with the new act, right? So very important. So now all the circulars they have said would be continue to prevail. For example, the circular for pre-deposit in the current Income Tax Act, that would continue to prevail if a new circular does not supersede. Now, the officers, whenever it is in their advantage, whenever it is to their advantage, they would try to use the circular, and whenever it is not to their advantage, they would say it is inconsistent with the new Income Tax Act. So possibly here a clarification may be, or more clarity would be required. Again, for MAT credit, which is carried forward, that would continue to be carried forward in the new Income Tax Act as and when it is implemented. What about TDS credit? Say, for example, in financial year 25-26, TDS is deducted on advance basis, but you offer the amount for taxation in tax year 26-27. So how the TDS would be carried forward? Of course, from what it seems, TDS credit would not lapse. It would continue to be carried forward. But again, it is required to be deep dived as to how the TDS credit would be carried forward. And so the return filing again becomes very, very important. The last return filing, possibly a new return for these transitional provisions would also see light of day. So again, any loss under capital gain would be carried forward. There is some confusion whether the carried forward long-term capital loss would be allowed to be set off with short-term capital gain. We do not think that is possible. So that would be clarified, we feel, going forward. Provision for bad debt would be allowed to be carried forward if bad debt is not written off in the current act. So this is all by and large, but to the extent over the last 2 days, we could deep dive into the transitional provisions. This is what we have analyzed, but I'm sure that, transitional provisions would require a lot of deep diving, a lot more deep diving and planning over the next 1 year so that the transition to the new bill is seamless. Non-profit organizations, they have kind of accumulated at one place clauses 1334 to clauses 355. They have accumulated it all at one place. But one important thing is that in the new provisions in the new income tax bill 2025, it seems that the investment, if any ineligible investment is made for by the non-profit organization, the value of the investment itself would be required to be taxed. Currently, only the income arising from such investment is taxed. So that need to be further deep dive. TDS, by and large, the same TDS as has been represented by all the associations, taxpayers, trade associations. 71 sections have been combined into 11 sections. Main clauses 393 and 394. 393 is for TDS. It has 4 tables for residents, non-residents, any person, and where no TDS is required to be deducted. So I personally feel it is a lot more simplified. TCS, all the rates, thresholds are in clause 394, right? Low TDS deduction certificate, they have removed the word nil. TDS deduction certificate. So that requires to be seen whether the officer would sanction a nil TDS deduction certificate, because the word used is only lower TDS deduction certificate, not nil TDS deduction certificate. Also, the LTDS deduction certificate or LTCS deduction certificate, TCS certificate, they could be cancelled. As of now, they cannot be cancelled, but here in the new law, Income Tax Bill 2025, there is a provision for cancellation of such certificates. Otherwise, all, as I said, all the TDS amendments as per Finance Bill 2025, they have also been carried forward, right? Simplification and conciseness. Well, a lot has been said about the simplicity of the act, the reducing of number of words, etc. So I would not further go, deep dive in the interest of the time. So by and large, this is all about the quick glimpses, the first prima facie our analysis of the income tax bill. Over to Girdharji. Girdharji, you can take the session forward on the assessment and the appeal changes in the new income tax bill. Also, from your experience, what is happening in the income tax tribunals and high courts, and what are the new burning issues? Over to you, Gitaji.
Thank you, Vivek. Just be sharing my PPT. Am I audible, I believe?
Yes, sir.
Oh, audible, Gitaji, but voice is breaking, but otherwise.
Can you see my PPT? No.
Blog, Gitaji, on top of your PPT, there is a. Can you put the PPT in the view mode, presentation mode? And blog would go.
Fine.
No, no. Yeah, now it is fine.
You can see my PPT and I am audible.
Yeah, audible.
So starting with means where Vivek ji has left and means Vivek ji has covered almost all what major changes, though there are means the earlier act only been carried over here in the form of bill, and obviously the finance bill 2025 has been taken care of, and that might be the reason that the honorable FM has taken a week's time, because the finance bill proposals definitely not means in public and being in confidential mode, so that where means being given later on to the committee to incorporate into the finance bill, this income tax bill 2025. So now we are means in hands the income tax bill 2025. Vivek ji has elaborately has dealt up the issues and the changes and the probable cautions and probable preparations we have to do as a taxpayers. And obviously they are claiming and obviously the things have been simplified, but when we enter into the litigation world, these small simplifications or moving a word from here to there sometimes become the a big litigations, as we seen in two rounds of section 148. Obviously I am dealing with the chapter 16 of the finance, this income tax bill 2025, which deals with procedures of assessment. And we talk about assessment, it is the reassessment which takes the larger step. And Vivek ji has covered that the department might take things beneficial to them, the words, the details, simplifications which come best to their favoring. However, the law says, and the Honorable Supreme Court has already held in Vatika Township, that where there are two views possible, the view which is more beneficial to the SSC should be taken up, and not which is beneficial to the department. But that we see rare in present times, and obviously department takes up the other view which is beneficial to them, or which somehow is there to create revenues. But finally, that revenue is coming to their kitty or not. That we all see the courts are there, and courts have held time and again the right perspective of reading the tax statute and right perspective of dealing the tax statute. In case of Ashish Agarwal, in case of other judgments later on, we will be dealing the judgments on assessment procedures also at the end. Coming up is this procedure for assessment. which has been given to me. I'll be just moving the section one by one because there are no changes as such per se, leaving few of the sections which are there, particularly the reassessment again I emphasis upon, which was earlier 148 and now it is 279. So coming to 142, which is earlier in the Income Tax Act, which is now 268, inquiry before assessment, which remains the same. And the AO has to issue the notice under section 268 now, which was earlier 142. We all know under section 142(1), the notices were issued. The next section is 269, which is estimation of value of assets by valuation officer, which has been uh, enlarged and means, emphasis in the Union Budget 2024. Many professionals has been included here to take up the valuation of the land, building, place or asset of property or investment. And these were valuation officers, engineers, overseas surveyors or assessors. So these were not earlier, but as they were already there in the Act, they have taken the same. Section 270 corresponding to section 143 in the current Income Tax Act, which is dealing with the assessment. That's the regular income tax assessment, which is a scrutiny assessment and also includes the summary assessment. There is no change as such what they have proposed. I believe this assessment procedures and the litigation which quietly happens under these sections, because this is the first leg where the litigation starts, where the assessing officer put his views on the return being filed by the assessee, will be obviously kept in the same form as it is there in the Income Tax Act in the present form. Now we'll be waiting again the Finance Bill 2026, where just after that this income tax bill will be going to be implemented. The tax year and assessment year, which will be taken a test. Then obviously the Honorable Finance Minister will take up these sections and means, as suitable to the current practices and the decisions of the court. Those means, changes is supposed to be made in these sections. So the clauses remains the same. I'll quickly just move to section 279, which is basically the crux and which presently taking the larger scope of litigation, which deals obviously with the income escaping assessment. The 279 corresponding the present section 147 in the Income Tax Act, which deals with income escaping assessments. Here, a little change has been seen that if any issues which come to the notice of the assessing officer, supposingly assessing officer has recorded a region, given a notice under the current section of 148A clause B, and for which he has later on past being satisfied the fit case, and later on during the assessment proceedings he has come to know of something which was not covered earlier in the regions. So here it is been added that the assessing officer will not be requiring to take any approvals, or if it was not covered even in the earlier regions or the coach given to the assessee, the assessing officer can swiftly move into the issue and means, take the assessment on that particular issue itself. For that, where the assessing officer issues the notice under section 280, which is crucial. We have seen this section, particularly which is section clause 280 in this income tax bill, which was earlier section 148, has gone changes as far as the years till which the notice can be given in last 3-4 years. The first, in the earlier Income Tax Act, which was before 2021, the major shift has been done in these sections. The assessment, the years for which it can be reopened was 6 years and 4 years. And later on from 2021, it been changed to 3 years and 10 years, and for which the larger litigation has happened. Later on, they have changed it to 6 years, and last financial budget, they have made it to 3 years and 5 years. 3 years and 5 years. Again, they are changing here. And one important aspect we'll have to see here, that assessment year is no more now. So earlier the timelines were all linked with the assessment year. Now the timeline is linked with the tax year. So here 3 years if the issue under uh, understood to be escapement of income is more than is up to 50 lakhs, 3 years from the tax year. And if the issue is which is understood to be escapement of income is equal to or more than 50 lakhs, then another 3 years, that altogether 6 years, the notice can be issued. So one aspect we'll have to see that 6 years now from the tax years. Tax year. So basically earlier what 6 years was from assessment year. So now it is 6 years from the tax year. So effectively it is 5-year comparison to the earlier assessment if you compare it. And that again they have added one more thing, that in the first year, that 1 year from the tax year, the no notice under section 148 of the current Income Tax Act and 280 of the clause under income tax bill, no notice up till 1 year from the tax year can be issued. The sanction, which is the crucial as far as 148 and the 279 provisions are concerned, that remain the same, and the power remains with the additional director, joint commissioner, additional commissioner, and earlier where the two hierarchy were involved, now it remains with the additional commissioner, additional director, joint commissioner, joint director, and not the two hierarchies that which were the major point of litigation. One more thing which is already there in the current Income Tax Act, that if any information is received under e-verification scheme or under which is covered under section 135 of A of the Income Tax Act, that if information received in that mode, then the income tax officer has not required to go for the so-called proceedings, which is covered here under section 281, clause 281 of the current income tax bill, and which was earlier in the Income Tax Act 148A. So in that case, the assessing officer need not require to go to the that procedure, and he can straight away issue notice under section 279. If we move to clause 283, which is provisions for cases where assessment is in pursuance of an order or an appeal. Here it is important to say that if the effect is to be given on account of any finding or directions contained in the order of any authority, tribunal, or a higher court, the time limit has been given away. And one more thing is included here is the directions issued by the approving panel, which was not earlier. So the directions, if any, from the approving panel, so there means, without any timeline, the effects can be given in the assessment order. So the limitation period will not operate here. Now we quickly moving to clause 289. 289 deals with the notice of demand, which is there corresponding section 156 in the current Income Tax Act, where the assessing officer is required to serve a notice of demand on the assessee, specifying the amount payable. And if the sum is determined by payable, the intimation under those sections will be considered notice of demand. Now here they have means, related it with the ESOP provisions, where in case the assessee's income includes earning from specified securities or set equity shares from the eligible startup, the tax or interest is payable within 14 days of the earliest of 60 months from the end of the 11th year, which was earlier or presently is 48 months. So this basically, I believe, is the effect of the tax year and the assessment year, where the 12 months is added in this clause. So that means, 12 months on account of assessment year, which is not there now. So 60 months time is given in this case, 60 months from the end of the 11th tax year, from the date of the sale of security or shares of the assessee, or the date of the assessee ceases to be an employee of the employer who granted the security or the share. So this is something effect, as I discussed, that this assessment year and tax year may be a point of great litigation in some of the cases, or a deeper understanding is required. Now the assessment of block period, which is there in clause 292. So the assessment in block period, as we all know that earlier it was the 12 months from the end of the month in which the last authorization for search were executed. Later on, it been means, done to the last month of the quarter in which the search authorizations were executed. Now again is means, bring back to the last of the month in which this search authorizations has been given. The rate of tax which amended from the last finance bill, which was 60% in case of search and seizure, that remains the same. And again means, one search assessment pending being another search takes place, then the pending assessment must be completed first. The new search assessment will be conducted separately. And if less than 3 months are left for the new assessment, the period extends to at least 3 months from the completion of the first assessments. So that's the scheme for the search assessment. The block period was the same, only the quarter end and the month end has been brought back. That somewhere completes the chapter 16, which is procedure for assessments. The major provisions remains the same. Only few tinkering change or the consequential effect of the tax year and the assessment year has been incorporated. And now if we will move to chapter 18, which deals with basically the appeals and revisions and alternate dispute resolution. Here again, the majority of the provisions as far as the appellate proceedings remains the same. Few tinkering changes and simplifications obviously of the words. Has been done. I will quickly move to clause 375, which is
Your PPT is going back, Kirtanji.
yes. I am just on clause 375, which is where procedures when SSC claims identical question of law is pending before High Court or the Supreme Court. Here, what it was the position that the SSC has a option to submit a declaration in the form as prescribed to the assessing officer that if the similar point of law or similar question of law is pending before the Honorable High Court or Supreme Court in these matters, in the related matter, then he can submit a form that if he is not going into the litigation afresh for the another year for the another case involving the same question of law, then this duplication of basically litigation does not happen. Here, this income tax bill has also included the SLP, which is under section 136, which is article 136. So this SLP is also included. One final thing, if I'll just cover before taking up the case laws, which is the DRC. So the Dispute Resolution Committee, which was there in last 4 assessment years, newly introduced. Here the condition of there should be a specified order and there should be a specified conditions. So the specified conditions has been removed in the new income tax bill. So now remains the specified order only under the dispute resolution committee. Now if we can move on to the, as I said, there is no much amendments or there is no much details in this basically income tax bill, leaving what we have discussed in different clauses. And obviously, we will be looking up the part change. Obviously, to my understanding, much changes or incorporation of larger details in the coming up budget in 2026 as far as this assessment procedures or the appeals provisions are concerned. If they remain the same, obviously a tax stability will be there. Now moving to the judgments or the current happenings in this space of assessment proceedings, we all know that 263 is always a point of litigation where the commissioner can can review the orders of the assessing officer. So here again in this case of ACIT Central Circle to Raipur versus Satya Power and Ispat, which is by the ITAT Raipur, where in case of an assessment which has already been completed, so it is settled law that no assessment or reassessment can be done on the unabated assessments or completed assessments in absence of any incrementing material. So here the another settled principles for invoking 263 is that the order of AO should be erroneous and prejudicial to the interest of revenue. These two conditions must be fulfilled before invoking the provisions of 263. But here in case of Manish Packaging Private Limited, we have the Surat ITAT Quest, the provisions invoked by the PCIT, where the AO has already examined the provisions of Section 80, the claim of Section 80IA by the SSE, where the SSE has given and furnished the required details, the required certificate in Form 10 CCB before the assessing officer that was there, and the assessing officer has gone through that. So the 263 provisions according to the ITAT cannot be uh, can be invoked, and thus the said invocation of 263, which was illegal, been quashed. It's settled that the reopening is an extreme step. Obviously, it is a point of greater litigation now. On account of this itself, the courts are taking basically the stringent view on the reopening cases where there has to be a fresh material, there has to be a fresh information, and it should not be simply the suspicion or an information, a third party information, which was not basically examined by the assessing officer by its own. So in the case of Deputy Commissioner of Income Tax versus DRS Logistics by the Hyderabad ITAT, where it was held that reopening cannot be made on the audit objections, and the AO has to enter into the verification of those third party information which been received, and the mere suspicion cannot means be the reason of section 148 reopening. Again, where there is already a regular assessment under section 143.3, the entire details were there before the assessing officer, and SSE has already gone into the detailed scrutiny. Assessing officer gone to detailed scrutiny. Now, if on the same material, on the same books of accounts, on the same financial statements, if the reopening has to be done, it has already held by the Bombay High Court in Hindustan Lever Limited versus RB Vodkar, reported in 268 ITR 332, that the regions recorded or the so-called issued has to be independent, and the AO has to record that what was the failure on account of SSE to make a true and full disclosure during the original assessment or in the books of accounts, which AO could not able to find during the original assessment. And that is the reason of again being a reassessment in the case of SSE. So the reason has to be spoken, and that fact that it was the failure on the part of the SSE has to be there on record. Now moving further, which is we have already discussed in detail in the previous slide, that there has to be failure on the part of the SSE to make true and full disclosure, which is again held by the Bangalore ITAT in the matter of United Theological College versus ITO exemptions, that if the AO does not making any allegations that it was the failure of the SSE, the reassessment, which are the special provisions, cannot be invoked in case of an assessment which is already completed. 263 we have discussed in the first slide, that the landmark judgment in the case of Malabar Industries Company Limited versus CIT is still holding the space, and the two conditions, which is the order must be erroneous and it has to be prejudicial to the interest of revenue, must be fulfilled, which has been again confirmed by the Rajkot ITAT in the matter of AAN Automobiles versus the principal CIT. It said that an assessment cannot be revised if there is no jurisdictional error in the order, or if it has been passed after due application of mind, where the assessing officer has already vouched and verified the details. So that order cannot be said erroneous. Maybe it is prejudicial to the interest of revenue, but the both conditions has to be fulfilled. So the Malabar Industrial Company Limited case still holds the land. Now courts coming up to the rescue of the SSE many a times, and that the SSEs which are not very much tax conversant, the tax consultants and the litigants experts sometimes get confused with the many stringent or the complex tax laws. Now here is the case of one lady which who was running some business and deposited some cash in bank account during demonetization, and the AO has invoked section 69A. The accountant done everything and basically submitted the return. And what happened and what the fact of the case, that the sister, there was a sister concern, and that sister concerns basically has been deposited in the account of the SSE. So the AO has made additions of that additional cash under section 69A. The court has come to the rescue and deleted the additions so made on account of the non-understanding or the complex laws not coming to the such SSE. In the case of Monica Chakravarti versus DCIT, this is Jaipur ITAT. Now this bogus purchase particularly been coming up as far as in the GST era, where these things are yet to be settled in the GST regime, GST laws itself, where if the sellers are bogus, if the sellers has not complied the GST law, the credit is not following and not flowing to the purchasers of those goods. So in GST laws, they are basically disallowing the ITC, and the larger implications are there. But when we come to the Income Tax Act, here the taxation is on income and not on the receipts or the turnover, where supposingly, if at all it is to be understood that or to be taken for the time being that the purchases are bogus, for example, though the SSE has all documents as far as in starting from invoice to lorry receipt to the purchase and sale documents and movement of goods. But even if it is being held by the GST department has given information to the income tax department. Income tax department opened the reassessments. But even then, whatever the sale understood to be genuine, the sale many a times and in all the cases not been disputed by the income tax officers or the income tax assessment, then only remains the gross profit, which there in the nature of business, or at most the 10-15%, 10% to 15%, which is the general range of earning gross profits, to be disallowed and not the entire purchases. This has been held by Mumbai High Court in PCIT versus Param Shakti Distributors, which followed the case of Sri Rajesh G. Jain versus income tax officers. But yes, the situations become little stringent in case of service dealings, in case of service transactions. In transactions of goods, obviously the movement of goods are there, the lorry receipts are there, and other corroborative evidence to justify. But in case of service contract, we obviously have to take bigger precautions, the much care, where the service delivery has to be records for service delivery to be kept on record. Say for manpower suppliers, the registers where the security got entered and exited, their logbook or basically their details to be kept on record, so to justify in the assessment proceedings. This is something a different what is the present uh, scheme of basically the legislation is there that plea of defect of notice taken first time in the High Court, not earlier, is an empty plea. So that says the Bombay tribunal in the case of Veena State Private versus Commissioner of Income Tax. But if we go to the larger discussion, it has been held by the Supreme Court in the case of NTPC Limited and many other judgments, where it has been held that legal issue can be raised at any stage of litigations. So the non-striking of the non-applicable part in the notice goes to the root cause of the basically proceedings, where the notice is issued for the invocation of penalty proceedings, and there if the AO has not satisfied himself about the wrong or the the panel provisions which is applicable to the SSC, the notice falls, and that again held by Honorable Supreme Court in Manjunatha Cotton Mills and SA Builders. There was celebrity judgments, so that cannot be obviously the SSC in this case will go to the higher forum and hopefully will be getting the relief. Now, for the fault of AO, the SSC said to have to suffer through new scrutiny. Here, basically, the recording of the facts and the details in the assessment order by the assessing officer. So many a time we give patra of basically written submissions or the supporting and evidences during the assessment proceedings, but we cannot hold the hands of the assessing officer what he records in the assessment proceedings in the assessment order, and assessment order obviously travels to the next stage of litigation or the next stage. So there, if something has not been recorded that what actually the assessing officer has checked or not, that could not be the reason for the 263 or the invocation of the review proceedings by the commissioner. But here it has been held in play again 24/7 versus Commissioner of Income Tax, Mumbai, that no, if it is not there in the assessment order, then 263 proceedings are good. The jurisdiction of the assessing officer is very important, because there are under section 127 of the current Income Tax Act, which deals with the jurisdiction of assessing officer, then who will be the assessing officer who will be looking at the assessment of a particular assessing? This again in the faceless era become very important as far as judicial assessing officer and the faceless assessing officers also for the same SSC, and this larger litigation under section 151A, and the notification issued by the CBDT. So here again in the jurisdictional assessing officers also, the jurisdictional assessing officer who is having the petitionary jurisdiction and the territorial jurisdiction has to be in charge of the assessment. But here the assessment was done by the non-jurisdictional assessing officer, which was held already held by the Allahabad High Court in MT Builders Private Limited, that such assessment is bad in law and that will not be hold good. Again, upheld by the ITAT Chandigarh in case of DCIT versus C. Manjeet Singh. The last case law will be taking up is the doctrine of merger of the order of High Court with the assessment order. Obviously, when the assessment order travels further and means the ITAT or the later on again with the High Court, the decisions or the judgment on the particular assessment order as given by the higher authorities will be given effect in the assessment order itself, and that merge with the assessment order itself. So the issue which basically been held by the higher forums, the assessment order has to incorporate, and that means become the finality. The ITAT Chandigarh in case of DCIT versus Valco Industries has held the same, and that's all with today's basically the case laws and courtrooms in the recent past. Will be coming up more on the similar issues and keep updating and keep sharing the knowledge. That's up. Over to you, Vivek.
Thank you, Girdharji. Uh, and thank you, participants, for joining. One important thing which Girdharji has said is the corresponding to this section 147 time limit for reopening that actually has been reduced from 6 years to 5 years because of this assessment year and tax year concept. So I think that is a major takeaway from this session. So thank you, participants. Over the coming 1 year, we would be holding regularly these webinars, and a lot of deep diving on the new income tax bill 2025 is required to be made, and we would keep on doing it. Thank you very much again for joining. Over to you, Namrata. Namrata, are you there?
Hello,
Okay.
can you hear me? Yes.
Yeah.
Thank you, Vivek sir and Giridhar sir, for this wonderful deliberation. Thank you, AIFTP, for coordinating this session with us. Thank you to all the participants for attending the webinar. We conduct such webinars every month and hope to see you in the upcoming webinars as well. We will shortly share the PPT and the video link to all the participants. Thank you all for
So
once again.
just a moment here. Actually, this PPT, we would be coming out with our book on section wise, clause wise commentary on Income Tax Bill 2025. So this PPT is IPR, so to say. The publication rights is with the publisher. So in this case, we would not be able to circulate. But of course, this PPT would find its way in our new book on clause wise income tax analysis of income tax bill 2025, which would be in stands in the coming week itself. So thank you very much again for all the participants. Thank you very much.